Your credit score is a three-digit number between 300 and 850 that most people know exists, but relatively few understand well enough to actively manage. It is, however, one of the most consequential numbers in your financial life. Your credit score directly influences the interest rate you pay on a mortgage, a car loan, or a personal loan, and the difference between a good score and an excellent score can cost or save you tens of thousands of dollars over the life of a loan. It also affects whether you can rent an apartment, how much you pay for some types of insurance, and in some cases whether certain employers will hire you. Understanding how it works is not optional. It is basic financial literacy. FICO scores, the most widely used credit scoring model, are calculated from 5 factors, each weighted differently. Payment history is the single largest factor, accounting for 35% of the score. It simply tracks whether you pay your bills on time. One missed payment can drop a good score by 100 points or more. Credit utilization, how much of your available credit you are using, is the second largest factor at 30%. Using more than 30% of your available credit limit signals higher risk to lenders. Length of credit history accounts for 15%. Older accounts in good standing help your score. Credit mix, having different types of credit like cards, installment loans, and mortgages, accounts for 10%. New credit inquiries account for the remaining 10%. A credit score above 700 is generally considered good, and above 750 is excellent. At 750 and above, you will typically qualify for the best interest rates lenders offer. To illustrate what that means in practice, on a 30-year, $400,000 mortgage, the difference between a 6% rate, available to someone with a 680 score, and a 5.5% rate, available to someone with a 760 score, is approximately $45,000 in total interest paid over the life of the loan. Your credit score is not just an abstract number. It is a direct financial cost that compounds over every major borrowing decision you make throughout your life. Understanding the 5 factors means understanding exactly which levers you can pull to improve it. The most impactful thing you can do to improve or protect your credit score is to never miss a payment. Set up automatic payments for at least the minimum due on every account. Payment history at 35% is dominant. A single missed payment can undo months of good behavior. The second highest leverage action is reducing your credit utilization rate. If your credit card limit is $10,000, keeping your balance below $3,000 keeps your utilization at 30% or below. Ideally, aim for under 10% for the highest possible score. This can be achieved by paying the full balance monthly or by requesting a credit limit increase, which reduces your utilization ratio without changing your spending. Several common myths about credit scores are worth addressing. Checking your own credit score does not hurt it. This is a soft inquiry, not a hard inquiry. Closing old credit cards can actually lower your score by reducing your available credit and shortening your average account age. Carrying a small balance on a credit card does not help your score. This is a persistent myth. Paying the full balance every month is better for both your score and your wallet. Having no credit at all is not the same as having good credit. Lenders want to see a history of responsible borrowing. And applying for many new credit cards quickly can temporarily hurt your score through multiple hard inquiries. You can check your credit report free of charge from each of the 3 major credit bureaus, Equifax, Experian, and TransUnion, once per year at annualcreditreport.com, the federally mandated free access point. Review all 3 reports for errors, which are more common than most people realize and can unfairly suppress your score. If you find an error, you have the right to dispute it directly with the bureau, and they are required to investigate and correct verified errors. For most people, consistently paying on time, keeping utilization low, and allowing the length of credit history to grow will produce an excellent score over time without any complex strategies. The fundamentals, done consistently, are all that is required.